Hello, this is video number 4, and hopefully everyone has been following along. We've been talking a lot about ranges. That's very, very important to understand the concept of range. Um, I think a lot of traders, especially short-term traders, don't talk about this very much, and because it's not exciting. It's not really exciting to think about a range as opposed to a move that could happen, say, over an hour. That's a $1 move, and a person could literally make $1,000. That's more what people talk about when you look at the YouTube videos and whatnot. And those are pretty rare occurrences. Most of the time, the market is moving very chaotically, or kind of ebb and flow like within a range, and then that range will move into a different range. So it's important to first think about ranges, and then the second way the market moves, which is the more common way people think about market movement, is waves. And that's why I did these two um, diagrams here. Waves is kind of like, the market may move up $1, then down $1, then up $1, then down $1.20, up $1.20, down 75 cents. So you'll see this a lot when you start looking at the shorter time frame charts, like say on a 15-minute chart, or even a half an hour chart. But when you start looking at the global picture, like the big picture charts, like the daily chart, the 12-hour chart, you're going to see that the market moves in these ranges, and these ranges might be $3 wide. So it might move between 53 and 56 and just kind of bounce around in there for several days, maybe even 2 weeks, and then it'll move into a lower range or a higher range. So that's what this video is about. I'm just really enforcing this concept of range, because I feel like, at least in my trading, I started with thinking in terms of these waves, but unless you have the larger concept in place where you're thinking about ranges first, um, then you can really start to see how the market is really moving. All right, so we have two types of movement. One is waves. We just talked about that. And usually you see this on a lower time frame, like a 15-minute chart or a half an hour chart, where the market will move up, say $1.20, down $1, up 75 cents, down 75, 80 cents, up $1.25, down $2. So this is what you see on the lower time frame. Uh, and we'll look at that in the second part of the videos. The first part of the videos, we're talking about ranges. And the market, basically when you start looking at the daily chart, the 12-hour chart, you'll see these ranges. Ranges are usually 3 to $5 wide, and they generally last for several days, and then the market will move into a different range. If the momentum is down, the range will move in lower, and then it'll consolidate within that range for a few days, and then it'll move into a different kind of range. So those are the two types of market movement that you have to keep in mind when going forward. So there are 3 different types of market conditions, and we will come back to this when we finish up talking about waves. Um, and we'll just touch on this here before we get into the other more detailed stuff. So first market condition is called a neutral market, and that's basically where the buyers and sellers generally have equal power. So what you see is the ranges are basically kind of moving in a sideways fashion. So over several days or several weeks, you'll see prices moving within this $3 range, and it just stays there. There's no no new highs or no new lows, and it just stays in a sideways pattern. The waves that do their general $1, $2 move up or down, but in general they stay in a range of $3 to $4 over several weeks. And so the point to keep in mind is that usually during these phases, the buyers and the sellers are in kind of like an equilibrium state. And you'll see this happen after the market makes big moves. Like it'll make a big $3 or $4 move. Then it'll settle for a few days or a few weeks in a neutral market and things will just move sideways. All right. So that's condition number one, neutral market. Okay. Sellers are resistance. So here your sellers up here forming a resistance level, and your buyers are down here forming a support level, and the power that they have on the price is about the same. So you don't get any new highs, you don't get any new lows, it just stays sideways. All right, and we're going to look at the second type of market. All right, second type of market is called a bear market or a bearish market. And generally in this market, the sellers have more control than the buyers. They're exerting more downward pressure on the price. So when the price, comes towards, say, a good seller price point, they push the market down. So you might see in a bearish market, you'll see that the price ranges are the same. Like you might have a $3 or $4 range. The price will move around within that range for a few days, and then there'll be a big push down. And that's, when sellers are basically in power. And then you'll move into a different lower range and consolidate within that range within a few days and make a lower low. And again, you'll see price bouncing around within that $3 or $4 range for a few days, and then after a few days, you'll see an extension move, like big push downward to form a lower low. So that's the bear market, where sellers have more power than buyers. The ranges are descending, and the market is closing lower lows. Now you'll still see this wave-like, pattern, but occasionally within the waves, you'll see a big push downward. After the range has kind of rested and consolidated, maybe over a few days, then you'll see another big push downward. Then you'll get into another lower range. So over time, the market is making lower lows and closing lower. So this is the bear market. Let's look at the final one, and that is the bull market. So in the bull market, the buyers have more control over the price than the sellers. And you'll see these ranges over time are slowly increasing, or they're moving into higher highs. So let's say if this range was 56 to 53, the price might bounce around in its wave-like pattern, and then after a few days you see a big extension move. Then the price will bounce around within that new range. So if this were 56 and 53, the new range might be 58 and 55, and you'll see it just bounce around within that range for a few days, and then after a few days another big extension move, and then you'll go into another little consolidation phase. So this is the bull market, but where buyers have more control than sellers. The ranges are ascending, and the market is closing higher highs. And you'll still see these wave-like patterns. Market moves up a dollar, down a dollar, up a dollar, down a dollar, and then one day it'll just make like a $3 or $4 move, and you'll get into a new range where things will consolidate, and after a few days another big extension, $4 or $5 move, things consolidate. So that's basically what I wanted to touch on in this video. I'm getting you ready for the second type of market behavior, and that is the wave format that we looked at in the beginning. Last couple weeks, really what I wanted you to appreciate is just the range-like behavior that you'll see, that you commonly see on the 12-hour chart, the 8-hour chart, the one day chart, and then as we start looking at wave-like behavior, you'll see that on a smaller time frame, like a 15-minute time frame, you'll see these wave-like patterns happening. But when you appreciate range first, it really helps you orient yourself to what is happening on the big picture. So, and we'll come back to talking about market condition, understanding what market condition is, then being able to analyze the ranges. Are they moving up? Are they moving down? And then the final phase is, where are you within the wave? And that's a whole different, that's like the second part of this series, talking about wave like mechanics. And once you understand those two, then you're going to really be able to say, okay, I know where I am on the chart. I know where the range is that we're playing within. And once you got that, you're just one step away from being able to trade, because then you'll be able to say, okay, well, this is a neutral market. This is an example I'm painting. Let's say you're in a neutral market and you've observed that there have been no new highs or lows for several weeks, right? Or for several days, 10, 20 days. But you see these, market moves up a dollar and down a dollar and up a dollar and down a dollar. Well, when you know you're in a neutral market, you could either be going short to take it down a dollar, or at this point you would be going long to take it up a dollar. All right? Because in a neutral market, it doesn't really matter what side you're on, as long as you identify where you are within the range. And we'll come back to this. So I just want to touch on it. So in a bear market, for example, let's say you've been observing the market making lower lows over the last 20 days or so. Well, the ranges are descending, and you know what range you're in, and then you're waiting for these pullbacks into the top of the range where you would be going short, or you might be, say, risking 50 cents here to the top of the range to grab this $2 or $3 extension that you've been anticipating. That's the usefulness of understanding that how the market moves in ranges and waves. So we'll touch on a little more on the range, and then we'll start talking about waves, and that'll put us more towards the end of the series where we talk about risk management and take things from there. All right, thanks for following, and I know this is a long process. The key to keep in mind is to apply what you know right away. As soon as you learn something new, try to apply that to the chart. Don't go through the whole course and then try to trade. That it doesn't work like that. You have to really just say, okay, he wants me to look at the range and that's it, and just do that for a few weeks before you move on to start thinking about something else, because it takes a while to absorb these ideas. You really have to see it happen on the chart over several times before you're able to apply the next step. So if there is any questions, just give me a call, and we'll talk later. Bye.